sitting there and going, do I want cash flow for cash flow's sake? Everyone says I should care about cash flow. Why? Do I want growth for growth's sake? Why? Ask a new member of like our investing club, like, hey, what are you trying to do? You know, like we did our own thing. We have our own goals, but what are you trying to do? And they may take months to answer that question, and sometimes they do.
Spencer, welcome to the show today.
Michael, Garrett, really great to be back. Thanks for having me back on.
Yeah, last time you were on our show was in 2019. It was episode 186. And actually, I think you still had a day job at the time, and you talked about certain financial goals, and you wanted to achieve them by investing passively, and you have now done that. You've achieved financial freedom by investing passively. So we want to understand that a little bit. Kind of give us an overview, and we'll kind of go deep in there. How did it get started with real estate and passive investing? How did you get started in that at all? Because most people invest in the stock market.
Yeah, and this has been such an incredible journey. Even hearing you say that, Michael, from 2019 to now, that was a quick blur of 4 years. So whiz bang version of my story. I was in tech companies for 13 years, similar to you, Michael. And so I went through that journey, never expecting to go work in Silicon Valley. My dad was a real estate broker. I used to be embarrassed to say that. So I grew up in a real estate household. That's what scared me into tech. I was cleaning out old fridges and rentals and working open houses for him, growing up in that lifestyle. It did go through a really rough patch back then. I won't go way into it, but I'll just say that my whole family went through like what we call the dark decade, when a bunch of tragedy hit the family, lost a younger brother, parents got divorced. I won't go super deep on this to bum people out, but I'll just say that hardship of any type makes us all pay more attention, and it sinks in. And what I learned from that journey, and I hold on to these learnings now as a dad with 2 young kids. And we were just chatting about this before we hit record today, Michael. I'm sitting not at home. I'm sitting about to take my kids to Disneyland for the first time tomorrow, which is one of the benefits of investing passively, is you have more mobility. But at the end of that tech journey, I realized after grinding it out, 18-hour days, all those stories we've all heard about in Silicon Valley. I've been at 5 different companies making great W-2 income. Jennifer, my wife, and co-founder, she had her own career, her own income. We were burnt out. I mean, we were trying to find that, Silicon Valley lottery that everyone seems to cling on to when you work for that early stage company, get the big Google exit. And ultimately, that's just not how it panned out at that time. So when you and I first connected, I was going deep down this rabbit hole of, man, can I go maybe buy a rental? So I knew enough to know I could go buy something that generated passive income. But as I shared in 2019 with you, and just give the Cliffs Notes, I look at it in hindsight, it's clear. Felt very unclear at the time when I first started doing this back in 2016, but bought a local rental. It was more work, low cash flow, $430,000 in Vallejo, California. Still have it now. Great appreciation. Still low cash flow. $200 a month for $430,000 is not a home run. By any means.
At least, so I did hit the software lotto, right? And so because the company I joined in Web Methods actually went public, and I realized though that it was the lotto. Like it was a very unusual, rare occurrence, and I was going to do it again. And I was like you, I was like, man, I don't know if I'm going to work another 12-hour days for the next 4 years for the possibility of some kind of payday. And but unlike yourself, I plowed all my money into restaurants, which seemed like a really good idea at the time. And at least you plowed it into some rental property, which is, of course, not that great of idea and either, but vastly better than restaurants. But as you got into it, right, you're like, man, what should I do? This thing isn't really producing a lot of cash flow. How did you educate yourself about what to put the money in?
I devoured content, and I listened to, at the time, upwards of 400 plus podcasts in an 18-month period. I got the bug so bad, Michael, and your podcast was one of the top of the list. I was really engaged with it. I was like, wow, there's a different way to do this. I read too many books, flat out. I'll just say too many books, beyond the point of education into procrastination. Right? It was like 24 books or something in an 18-month period. A little bit over the top. But then I was actually ushered into this is my last W-2 gig, and I left in 2019 ultimately. Very, very end of that year. I mean, at the same year you and I recorded that podcast, it was ahead of schedule. I was working at a fix and flip tech company lender. It was all those things in one. So I saw all these different investments that people were making, and we were helping them make them and fix and flipped. And I was like, I can't swing a hammer. Like I hurt myself if I do that stuff. I'm not handy. Jennifer's more handy than I am. Not ashamed to say it. So all that to say, I was like, where's more predictability? Where's more forecastable, big, business plan, business operations style investing? And then I looked at, wow, let's go look up market. And then I found your education, frankly. I mean, I found your program. I remember purchasing the SDA. It was one of the first versions, if not the first version of the syndicated deal analyzer. Michael and I, by the way, didn't talk about any of this ahead of time. I didn't even tell me to say that. And I'm just sharing it because that's what happened. Like I bought the damn thing and it was super helpful and educational. And I was just deep down that rabbit hole saying, I want my money invested in something that produces cash flow better than $200 a month for a $430,000 purchase price. And even after buying turnkey rentals, we got it to a portfolio of 5 turnkey rentals in the Midwest, which was fine, better purchase price. $60K a pop is mind-blowingly cheap for someone sitting in a coastal market of any type. $250 a month in cash flow. So flash forward, we started investing in these bigger deals. And I was like, wait, I don't have to do any work. Don't have to even manage the property manager, which is semi-passive at best. Even I'm not against rentals overall, but I'll just say there's no such thing as a fully passive rental. We've since sold our rentals, except for that one first non-home run. It's appreciated, but beyond that, we came into a place, Jennifer and I, where we're like, this is a system. If we really plan this out, we can invest over time. So we started carving out chunks of 25K, 50K, eventually bigger amounts. We'd saved up money from our tech careers. And ultimately started to get some momentum. And one of the first deals that we exited full cycle was actually with a Nighthawk deal as well. And we were very pleased with that outcome. I mean, it was like a 3-year hold period, and over like a two point early, can't remember the exact, it was like 2.2 or 2.3 equity multiple in that period of time. Mind blown at that point. And we just kept on doing it, while finding ways to also add value to others too. Because I was sitting there going, I know so many people in my network, and I'm sure you do too, Michael, where they're still in that machine. I don't want to be derogatory. I had a great W-2 career and I learned a lot, great relationships, but my goodness, people hustling hard for years without an exit strategy of any type, dropping money into investments. And so I thought cash flow was key so we could de-risk our own lives and build a moat around our life.
Yeah.
Get more flexibility.
But yeah, in defense of so many other people, I had my money, my IPO millions with, Morgan Stanley at the time, right? And I was like, man, I'm gonna let the professionals handle my money, right? That's literally, I got the statement. I didn't even look at the statement every single month, right? And I think most people that have money to invest, that's exactly what they do. They hand it to a financial advisor and they think that they're actually looking out for them. And in hindsight, I'm like, holy cow. All he wants to do is churn stuff so he gets paid commissions. Like it's incredible. Now, so there's a lot of comfort and a lot of fear with alternative investments, which is syndication is an investment. How did you and Jennifer overcome that fear, right? Like in your mind, had a conversation. Hey, we got some money to invest, and I don't know, maybe it's not the stock market. We should try some crazy stuff. Like, how did that go?
That is very much how we thought about it, right? The crazy stuff comment is making me chuckle because that's how we were sitting there trying to wrestle with it, like a lot of us, right? It sounds crazy, and you get the reactions from friends, get the reactions from family, and they say, "Are you out of your mind?" And
that's
then,
right.
but it's just what we're all conditioned to do. I was so proud of my 401ks, right? I was so proud of dumping and maxing out money for years in 401ks. We'd sit there and celebrate those things. And I'm a big fan of frameworking. I think in our conversation back in 2019, we might have talked about this a bit, Michael, but I love being able to make smart decisions. Even better if you can make smart decisions with some speed, if you need to, and you have to sometimes, right? And in tech startups, that's what I learned from people way smarter than me, man. How do you framework it? So we put together like a framework for ourselves, for our own money, and we were like, if we find deals that meet this framework, and some of which inspired frankly from the SDA and the teachings that I got from you and from your program. And if we look at it like this, it's a 5-part framework. We still have these bullets now, but we've built out a lot more structure around them. And so it's, who's got the deal? How do you de-risk? Who's managing the deal? If we're not managing it like a rental anymore, who's managing the deal? where's the market, and then of course the business plan. I didn't come up with those 3 buckets. The real meat is the 5 that we have beneath that, in my opinion. So we look at the track record, the approach, the team, the communications, and the values. That's how we got more comfortable. And I have a very nerdy spreadsheet beneath that, of course, with, breaked out with 70 plus questions and criteria. And just to give you a sampling of like the ones I think are most important to me and Jennifer, before we can really get comfortable with this stuff, was like same principles from entrepreneurship and tech. Failure response is kind of nerdy branding, but I like it a lot. It's like, has someone been through a really, really challenging time? If they're managing a deal, if they're going to, be managing an apartment building, and I'm holding shares in a piece of this big building I couldn't buy by myself, like, have they gone through a really, really challenging experience and come out the other side? Because none of this is easy for the manager, right? Even if in a great rising tide market, I assume there's going to be hardship, there's going to be headwinds, there's going to be stuff. And so that, those are the kinds of questions we have to ask just to get ourselves comfortable with it. Of course, all the numbers, you got to understand how to read a spreadsheet, but like, really, it comes down to that who, and like, are they able to go and operate, if I'm investing in a passive deal, with a repeatable business process? That, if I had to boil it down to, got the track record, sure. Anyone who's done something, whether it's me playing my hobby guitar, used to play more metal and punk rock back in the day, and now performing for my kids. If I'm trying to learn a new technique or learn a song, if I've done it enough times, 100 times, I've got a process to learn that thing now. Same thing goes, with an apartment building, way harder to do, such as you guys in Nighthawk, like, you get through enough cycles, you can build a repeatable process. And so that was the great equalizer, I had to say, is we sat there and made a framework and decided, if we find deals that meet these criteria, we're ready to pull the trigger, assuming we have the capital really ready to deploy, And so I get excited to talk about it because I feel like it's been a labor of love getting it to the point where we can have confidence in it to that degree. But yeah.
What created you to build this framework? And then how do you get the right answers out of some operators to actually get them to admit like some of the tough failures, tough losses when you're interviewing them, so that you feel comfortable moving forward?
Yeah, I appreciate you asking that, Garrett, because that's like where the rubber meets the road, right? When you're getting to know any other human being, whether it's in business, life, whatever, I think it comes down to not hitting them with an interview or a job interview, right? Like, these are human beings working hard. I don't want to come in and say, is everyone prepared to answer my 70-point list of questions?
Yeah, exactly.
No one wants to get slapped with that verbally, right? I don't. I've been on both sides of the interviewing table in my prior life so many times. I know how it can feel. In the end, being respectful to the core in timetable, like if you ask for something, be reasonable, but also, if possible, try and get face-to-face with them if you can, even on a Zoom call. I mean, just like this, if we can connect face-to-face, even if it's virtually, build some rapport, get to know them, and then also show them an indication of seriousness in any way, shape, or form by like letting them know, your own track record as a passive investor too. I'm so proud to say, like, we've now deployed over 7 figures of capital into deals, and that's across a lot of darn deals. So it's not like we're doing it in abstract, purely just to kind of say, hey, hey, operator, hey, sponsor, tell us all these answers to these questions so we can never see you again. It's like, let's go build a relationship, ever deepening, but at least starting on that first call, just saying, here's what I'm coming correct with. Like, here's how we view deals, sharing how we view deals, sharing why we're asking these questions. And one other example I'll give you as well, Garrett, like, is a question that has actually prompted us to not go forward with a particular sponsor. And it might feel out of left field for some folks, is that on values, it sounds all squishy. It's not squishy to me, in the sense that it's really just more behavioral interviewing. Like, if I'm going to say, tell me about a time when, those wonderful, terrifying questions that we've all gotten in job interviews at some point or another. If I'm asking a sponsor, getting to know each other, and I'm like, hey, like, what's your philosophy on tenant experience? How do you know your tenants are taken care of in that building? Like, and we walked away from one sponsor because asked the same question a few different ways and very nicely, and all that they would want to do was change the topic, and it was like, maybe for some people and it's absolutely fine if they don't agree with that. But I think making sure you give people a chance to answer in their own way, but eventually they do have to answer the stuff that really matters to us. And whether it's failure response, if they haven't been through anything really hard, like, it doesn't even have to be from real estate. If they tell us about a time, tell me about a time when you've been through something where you were you thought you were about to fail out in a different entrepreneurship venture. And Michael, I appreciate you earlier sharing, your story from the food business, restaurant business. I mean, you better believe I would count that as a valid story.
You better.
Yeah. I mean, come on. That's crushingly
Put
challenging,
hair in my
right?
chest, let me tell you.
Yeah, oh my gosh. The food industry is no cakewalk.
It's funny. It's funny that you mentioned that one question. That I sometimes reference that one question. I don't really care, not so much that if you're a new syndicator or not, but I do want to know the same thing. Have you been through really hard times? Because if you have not, you're not going to be able to deal with that level of stress, and it's going to impact your ability to make decisions. So it's interesting that you highlighted that. But I'm curious, Spencer. What are some of the alternative investments you guys invested in or looked at, and just kind of go through the list with maybe some pros and cons? Because I think a lot of people are going to be interested to see what have you looked. You talked about turnkeys. Let's start there, right? A turnkey is a great. So you get the rental property. Okay, we get the rental property. It's not so scalable, and the cash flow kind of sucks. Okay, next, and you got it's very active. Okay, next, of course, is turnkeys. What's the problem with turnkeys, if there is one?
Yeah, and I'll try to do my best kind of version of a mental pros and cons little T chart, because I'm that kind of nerd. Turnkeys, well, they are what they should be, what they claim to be. Easy to buy, easy to manage. Comes with the property manager, built in, comes with the tenants leased. Well, what happens on the flip side of that chart when maybe that tenant is not so easy on that property? Do you want that tenant leased? And turnkeys oftentimes you will find are going to be based in C class, and C class is a fine asset class, whether it's single families or otherwise. But folks just need to think about really looking at that neighborhood. Is it a D plus in reality? Is it not just a C? Because when the rubber meets the road, no matter how much I tried to de-risk remotely, I didn't fly to some of the turnkeys that we bought. I even paid for a company to go and visit remotely in person, take videos of the block, really get in there. And I thought, okay, there's a little bit of concern, not a red flag, yellow flag, but turnover every year is kills your financials, right? I mean, like one tenant, one property, they leave 0% occupancy. Then you've got the turnover cost because the property took a couple dings, and then for no reason, the tenant puts a couch out on the front yard, which causes the city to fine you, and then you're getting mail out in a different state for no reason, and you have I could go on and on.
This is pretty funny because not funny, but this is how I learned the business was this essentially. I own like turnkeys, but in D class neighborhoods, so you had the element of crime on top of it, and it's like even if you rehab the entire site, let's say you do, it's a 3 flat and you do all 3 units, and you have to put Section 8 in there. They don't care if they destroy your site. And then you have all those costs when they leave. So it's like, why did you even rehab it in the first place? It's not really enough to call insurance over, and you don't want to do that. So it's like, it's never ending really when you get to that. And then having the multiple sites everywhere, even if you bump it up into C class, you're still dealing with those types of issues. So
the turnkeys aren't really that profitable. They're not really that passive either. Now, obviously,
Correct.
You looked at multifamily syndications. We talked about what else have you invested in or looked at?
Yeah, and so to run down the list, and then we can dive into whichever one is interesting, because I find them all pretty interesting in their own ways, right? But I would say beyond multifamily, very big focus on like self-storage over the years. We did a little bit of mobile home park. What else have we done? Medical office. So I think beyond that, we've done even a little bit of crypto. Feeling that now. I won't go further into that. Still have it, still a long-term believer, but feeling it now. And then niche, like really other just stranger niche stuff that you guys are probably familiar with, but maybe some folks are not, because I wasn't a few years ago, like ATMs. ATMs. And I've looked at others, gotten very close to pulling the trigger on industrial, gotten very close to pulling the trigger on data centers, but ultimately have kept to the things that I really taken the time. I've taken the time in my own mind to feel like I can say, I know this well. And every time I violate that principle, man, do I pay for it. So I try to stick to my swim lane.
It's a good point. It's a good point. I mean, it's like data centers, perfect example, right? How do you break into a new asset class? Let's talk about that, because data centers are wildly profitable from what I've heard. Okay, but you're right. Would I invest blindly in data centers? I'd be like, no, I don't really know anything about them. So what is your process? Now, I know you talked about interviewing the operator, so we've covered that already. But when you're breaking into an asset class, what do you do? How do you go about investigating that asset class to the point where you either say, no, not for me, or yes, let's go?
Yeah. Oh, that's a fun question. I think goal setting, not to be abstract at a high level, but drill down quickly. What's the goal for the money?
Right. No, that's really important.
Like what's the goal for the money? Man, I wish I had heard that earlier in my investing career, right? Because some folks, particularly in 2023 right now, they are so laser focused on expectations that they have built from the past 3 to 5 to 7, 8 years. They still want that high growth with risk adjusted profile, and they want big growth and big cash flow. And I'm sitting there going, hey, me too. I think everyone does. But if I'm looking at something, whether it's self-storage or mobile home parks or whatever, or data centers, I'm sitting there going, okay, what are the core fundamentals of cash flow versus growth, and some combination in between, maybe with some other conversation on tax. And I don't like to overcomplicate it beyond that until I've answered that question first, is do I want our capital to help us produce any form of passive income? Or are we comfortable saying, screw the passive income, just the growth is fine. Don't need any cash flow. Okay with some tax benefits on top of that, but we just want this money to grow. And I struggle with that still. I don't think that ever is going to get easy. And maybe you guys have an answer on that I don't have, but I think goal setting for life is the first order of business that Jennifer and I started with back in 2016, before I even started learning alongside the resources and education that you and your team provided, Michael. It was like sitting there and going, do I want cash flow for cash flow's sake? Everyone says I should care about cash flow. Why? Do I want growth for growth's sake? Why? Ask a new member of our investing club, hey, what are you trying to do? We did our own thing. We have our own goals, but what are you trying to do? And they may take months to answer that question. And sometimes they do. You have to start there.
Yeah, it's a good point, because high cash flow means that your money is coming back. You're not going to reinvest the cash flow. So it'd be better use it to maybe, I don't know, buy something or offset your living expenses. Growth is basically compounded, right? So you have that. And finding the balance between the two, you have, there's, for example, debt funds out there. You can invest in debt funds.
Yes.
They just give you basically a straight 10%, return, no upside at all. So that's really cool for cash flow. Doesn't give you any depreciation, right? So you want depreciation? That's not going to work. Multifamily is better, but even for example, oil and gas. I don't know if you looked at that, but my understanding is that the tax benefits is that you can actually offset your active earned income with the losses off the investment, stuff like that, right? But of course, that's super high cash flow and not really appreciation and growth. So I think it's a really good question to ask. And you're right, there probably should be a mix. There must be a mix.
And there must be a mix. And also, I want to give some real numbers to folks if I can. From our time, we started in 2016, really educationally on this stuff, getting deep, buying rentals, et cetera. We connected on your podcast in 2019. At that time, I was still working. Jennifer, my wife, and co-founder of our investing club, she was still working. She ended up leaving in her job 2021. And then, now we're fully passive, able to do what we want and work actively if and when we want. But the journey that no one can tell you about, and I wish I could go back in time and just say this to myself, is, okay, you guys set out, and at the time I shared it with you in that podcast, Michael, we had an $8,000 a month goal for full passive, right? For some people, that's tiny. Good on them. I'm not looking for a jet over here. I'm just trying to figure out how we can be a great dad, be present with our kids, and live life fully. For some people, that's massive, but that was our number at that time. So what did we do? Well, we wanted to find a balance of cash flow and growth. At the time, we could find pretty darn good equity multiples, right? We could exit it on the Nighthawk deal. We exited along with you and your team over 2x equity multiple and do that in just a few short years. Now, that said, before we hit that cash flow number of $8K a month, which we've now hit, and I'm so excited that we've hit it, and I'm kind of pinching myself. We thought we were going to hit that number 15 years out. And that was the goal that we had set in 2016. We gave ourselves a long runway, a no excuse runway. And we said, as long as we plan this and we stick to the slow wealth plan, we're going to get to that number. It was too slow. Within about a couple of months, we had another goal setting session. This is back in 2016. And we were like, cut that number in half. How about 7 years? We ended up hitting it in about 5. And I wish I could go back and say to myself, set the goal and then just start taking action toward it, because what's going to happen, and I promise anyone out there who is like sitting there going like, oh, I don't know, it's like 2023 and I'm hearing these headlines, it's nerve-wracking. I'm like, I promise anyone that is in that headspace and they haven't done any of this passive investing stuff, you don't know what you don't know yet. And that's not a bad thing. What that means is that you're going to get into a deal or two and you're going to realize with more clarity every single additional time you invest, just like we did, how to get better at goal setting on this stuff. And but you won't benefit. Like, we never would have gotten to this point where I can speak with clarity about this stuff unless we just gone through and done the damn thing. And so I know we're not talking chump change, like I don't want to make it sound like I think of 25K as a small, irrelevant number. It's not. I know there's some big, very successful folks out there who think of that as chump change. For anyone, that's still a meaningful amount of money, right? Yeah. But we had to get started. And so I didn't want to give you too much of a soapbox on that, but I really, truly believe that. Like, if I could go back in time and just say, set your criteria, make a decision, vet the people, and then as you ladder up and the capital comes back to you from exits, whether it's multifamily, storage, or otherwise, I mean, I don't see a need to deviate from a target mix in our own personal portfolio of at least 50%. This is a fact. This is like our target portfolio for our own personal capital is at least 50% multifamily. And the reason that's not changing, regardless of the context of the market, is because the housing demand is there. It's not going anywhere. And it's got all those fundamentals of the entire asset class that I loved in the first place. This is a long game, and we're in a short moment relative to the big picture. So I didn't want to preach too hard on the multifamily thing.
We'll wrap things up here, but what is your outlook for this year? Just in general, multifamily, right? I mean, obviously, like you said, hey, we're not getting the returns we got 2 years ago, maybe even a year ago. You're not got the high cash flow, high appreciation, and zero risk anymore. What is your outlook this year for multifamily? Some of the investments that you're in, as well as some of the opportunities that you might be looking at.
Yeah, there was a brilliant quote, and I wish I could give credit to the person that said this. It has served me so well since I heard it about 3 or 4 years ago in an investing meetup. There's no such thing as bad assets. There's only bad prices. And I think that is a fundamental, helpful compass to think about where we are right now for any investor who's really trying to wrestle with all these darn headlines that are frankly kind of confusing and overwhelming for everyone, right? We've all been getting access to interest rates and cheap money, basically, including businesses, tech, companies, et cetera, real estate investors, beyond. What I see is, and I sent this in a letter actually out to all of our investors in our investor club. I said, there's 3 things that I think this year will be a focus for my money. And I would just encourage folks to go learn more about these things, because this is what I see as opportunity. Number 1, unsurprisingly, discounted, if not distressed, commercial real estate. It's not deviating from our core thesis. Is buying great assets in places with job supply and population demographics that support people living and using these facilities. The difference is now, for a variety of reasons, but largely because of interest rate rise, some of these properties are going to be going on a discount because the person owning it might have to sell for a variety of reasons, like maybe that they can't pay a balloon payment on their loan and it's coming due. Maybe the market is softened in their specific state and their submarket. That seller is like, gosh, but I just have to leave this property. That means anyone who's partnered up with a team such as yours, and Nighthawk, they can actually benefit from that moment. And so it's a time to just pay attention and sharpen pencils on the commercial real estate side. it is not the time for people to go out, in my humble opinion. And I'm not going to sit there and say, we'd better wait for when it's good to invest again, when everyone says things are great. No, that's kind of the opposite of what every wealthiest person on the planet insists on and has made their money from. Mm-hmm. I mean, what, pick Sam Zell, pick Warren Buffett, pick whichever example you want. I mean, read the platitudes. There's truth in those nuggets. They make money when things are not great because they buy the assets at the right price. And so that was the first thing I was just going to mention. Second was debt funds. I would actually just encourage that too. But the problem is I put it second for all the reasons that you highlighted very well, articulating, Michael, is like, I don't see a K1, Schedule K1 tax form showing wonderful passive losses to offset and defer my income tax on my distributions from my investments on a debt fund. But they're still a part of a whole portfolio. And then there's other niche weird stuff for number three. But that's kind of the overarching comment, I think.
It's interesting that you say that. I think we're going to see lots of opportunity in the multifamily market, commercial real estate in general, for the reasons you mentioned as well. So it's something we're definitely looking forward to, and we want to buy as much as we can when that comes. In fact, the deal we have right now is distressed somewhat because of that, and I think we're going to see a lot more in the summer and later this year. But this has been great, Spencer. Really enjoyed jamming with you. How can people connect with you?
Yeah, and honored to be back, and be able to share kind of a full circle experience. And thank you so much, Garrett. Thank you so much, Michael, for it. Folks can find me at our website. It's our investing club. It's madisoninvesting.com. They can reach me there. I'm also on LinkedIn. I took a very healthy break, but I'm very active on that again now. The passive lifestyle of, traveling and stuff with your family means you don't always get to post on social media as much, but I'm back on there now. So
that's awesome. Well, it's been great, Spencer. Thanks for being on the show today.
Yeah, thank you for having me. Really a blast. Thank you, guys.